Hello everyone, welcome back to Lulu's REal Way. This is the second episode of part 2, and if you haven't watched my series yet, go ahead and subscribe to the channel and watch my previous episode. Today we're diving into the art of picking the right market for our multifamily investment. In other words, how to know the where to invest for best returns. Whether you're a newbie or just need a refresher, stick around because this episode is going to break down this question from the big picture into the fine details. First things first, let's zoom out and look at the entire country. Why? Because not all states have the same regulations for property owners. Some states are what we call owner-friendly, and that means the regulations benefit the property owners. So if you need to handle tenant issues or set clear guidelines, the rules work in your favor. In owner-friendly states, it's usually faster and easier to manage things like late payments or property issues. These states can provide a smoother experience, which is a big deal if you're managing multiple properties or planning for long-term investment. So before anything else, we narrow down our search to these states to make things a little easier on ourselves. Alright, now that we've zoomed in on the states, let's talk about major markets, also called MSAs. Or Metropolitan Statistical Area. An MSA basically groups together a larger city with its surrounding suburbs and smaller towns. Think of it like this. When you invest in an MSA, you're targeting the central hub and all the little communities that feed into it. Some well-known MSAs can be places like Atlanta, Dallas-Fort Worth, or Phoenix. These areas typically have a lot going on. Strong job markets, growing populations, and demand for housing. We want to invest in markets where people are moving into, not leaving. So MSAs are a great place to start. Now let's say we've picked a few MSAs. Next, we need to dig deeper and analyze some data to see if these markets actually make sense for investing. Here are the top 5 things we look for. Vacancy rates. First up is vacancy rates. Low vacancy rates means housing demand is high, and there aren't a lot of empty units sitting around. For us, that's perfect. High demand means more people need places to live, which helps keep our occupancy rates strong and stable. We're looking for markets with low vacancy rates. This is a green light for us to dive in. Next, we got rent growth. If rents are going up steadily for a while in an area, that's a great sign. It shows that people can afford to pay a bit more over time. And as we mentioned back in our last episode, raising rents can boost the property's value. Investing in areas where there's consistent rent growth gives us a chance to naturally increase rents, which builds our income and equity, and may even help us sell for a higher price down the line. But here's a word of caution. We don't want the rent growth to skyrocket too fast. In some markets, rents shot up quickly, only to crash down just as suddenly. And when that happens, investors in multifamily spaces can end up with losses instead of gains. So steady, sustainable rent growth is what we're looking for in a market. Job growth. Now this one's huge. When companies move into an area and bring in workers, guess what? Those workers need housing. Job growth creates demand, boosting rents and keeping vacancy low. So we look for places with companies that are hiring or industries that are growing. This is one of the biggest factors supporting our investments. Population growth. Right along with job growth is population growth. If more people are moving into an area than leaving, that's a fantastic sign. It shows us there's a healthy demand for housing, which again supports our investment. Population growth often goes hand in hand with job growth. But even if the population is growing without big job boosts, it's still a positive indicator for rental demand. Cap rate. Finally, we look at the cap rate, which measures the returns on an investment property. The cap rate is calculated by dividing the net operating income, which is the income minus expenses, by the purchase price. So the higher the cap rate, the higher the returns on the property. But here's the catch with cap rates. Higher cap rate can also signal that the property has a low value or there's more risk. Low cap rates, on the other hand, could mean a higher price but also less returns. It's all about finding the balance here. High enough to make returns attractive, but not so high that the property turns into a gamble. Alright, now we have identified some promising MSAs based on our data. Now it's time to zoom into the submarkets. These are the neighborhoods or the smaller areas within the big MSA. Here is where things get a bit more personal. We start by reaching out to local resources, like the local Chamber of Commerce. These folks are often in the know of everything that goes around in their community, like planned projects, new businesses, population trends, and even zoning regulations that might impact the multifamily investments. We ask questions like, are there new companies coming into the community? What kind of growth do they expect? Are there any zoning changes on the horizon? All this information helps us figure out which areas are prime for investing and which are best to avoid. Think of the Chamber of Commerce as our market insider. They give us an extra layer of confidence when choosing where to focus our investment. Sourcing the deal. Now that we've analyzed our MSA and the submarket, it's time to start sourcing deals. This is where our research pays off. We now have a targeted list of areas that fit our criteria, meaning every deal we look at in this list of areas is already located in a place with high demand, high job growth, high population growth, good cap rates, basically everything good. When we source the deals, we look at the property itself, its condition, location, and income potential. But because we've done the heavy lifting in selecting the market, we're more likely to find properties that align with our investment goals. This is where all the groundwork we've laid starts to make sense, because we're putting our money and our investors' money in places that we believe have the best chances of bringing strong returns. And there you have it. Today we covered how to choose the right market for multifamily investing, from identifying owner-friendly states to picking the right MSA and zooming into the most promising submarkets. And we've also discussed some key metrics that help us decide which market fits our criteria. This step-by-step process helps us make smart decisions and reduces a lot of guesswork. Remember, every market we choose is like laying a foundation. Once we've got a solid one, we're setting ourselves up for success. Thanks for tuning in to Lulu's REal Way. If you enjoyed this episode, don't forget to hit like and subscribe to the channel and share it with a friend who's interested in multifamily investing. Watch my previous episodes, and as always, drop your questions down in the comments. I'd love to hear what you think or answer any questions you have about finding the right market.